Does your inventory quantity change for reasons other than buying and selling? Well, then you need to know how to make special adjustments for changes in quantities in special situations. If you have any questions about this topic, you can leave them in the comments section below and I'll do my best to help you. And of course, if you feel the video helped you, I hope you will click like and don't forget to subscribe to get updates on new videos that come out all the time. Normally, the quantity of inventory would only change for purchases, sales, and returns. However, sometimes there are special situations that could change the quantity of your inventory items without buying, selling, or returning the items. When these special situations happen that change the quantity, you must make an inventory adjustment to correct the quantity of inventory in your records. Examples of situations that you would have to adjust for are theft. If somebody steals some of your apples or bananas, the quantity changed in your warehouse without buying, selling, or returning. And you have to adjust so that QuickBooks knows the correct amount that you have after the theft. Same thing with a casualty loss like flood, earthquake, fire, tornado, any kind of thing that changes your inventory quantity, you would have to adjust for. What about spoilage? If you're dealing with food, sometimes the food spoils before you get a chance to sell it. And sometimes your merchandise becomes obsolete if other products or services come out in the market. As a result, you can't sell what you have on hand, so you just get rid of it. Your inventory also could increase if somebody actually gives you for free merchandise that you can turn around and sell. So these are things that you would have to adjust for that would change the quantity of inventory without buying, selling, or returning the items. You must have an account in the chart of accounts for each reason that inventory is adjusted. The account that you adjust for or that you use to make the adjustment is not normal income or normal expense. You must put them as type other income or other expense. These items appear at the bottom of the profit and loss, and they're not part of your normal operating income, but of course they will affect your overall net income. And some examples of the accounts in the chart of accounts would be loss on inventory theft, loss on inventory spoilage, and income from donated inventory that we received. Let's take a moment and put these three accounts in our chart of accounts. We go to the left and we click Accounting, Chart of Accounts. Now that we're in the chart of accounts, we go to the top right and click New. Now, the first one, scroll all the way down to get Other Expense. And it doesn't really matter the detail type, but I guess you could just basically choose exchange gain or loss, because that's really the closest one. But in this case, the detail type won't really matter. And we want to name it Loss on Inventory Theft. Click Save and New, because we're going to do two more. The next one will be Loss on Inventory Spoilage. So again, this would be Other Expense, not Expense, and probably the most appropriate detail type would simply be Other Miscellaneous Expense. And you would name it Loss on Inventory Spoilage. and you would click Save and New. Now this next one would not be income, it would be other income, because it's not part of your normal operations. Income from donated inventory received. Choose Other Miscellaneous Income. You can name it anything you like as long as you know what it is. Now click Save and Close, and now we have the accounts on the list to be able to make the inventory adjustments. Now let's do our example. Let's imagine on January 16th, we opened the inventory warehouse and observed that 10 bananas have spoiled and cannot be sold. Well, before you record this, make sure you click Reports and open your inventory valuation detail so you can see right now how many bananas do we have on hand. On hand, it says we have 180 bananas. So it will decrease to 170. Actually, yes, it will decrease by 10. So in order to make the adjustment on January 16th, we click New, and then go all the way to the right and go down to Inventory Quantity Adjustment. Now the date that we are adjusting for is January 16th, because that's the day we observed it. And the account that will hold the money that we lost on the bananas that we spent would be the other expense account, Loss on Inventory Spoilage. Now, click under the word product and choose bananas. Now, you have a choice when you put in the number. If you want, you could put the change in quantity as -10 and push tab, and it will automatically calculate the new quantity. Or you can change the new quantity, or, let's change that back. Let's put this back to 0. That means that your other choice is to simply type in the new quantity and push tab, and QuickBooks will calculate the change. So it's up to you which one you want to put in. When you put in one, it will automatically calculate and change the other. Now when we click Save and Close, we can look at the bottom of bananas, and you can see that on January 16th, we adjusted inventory. We have 10 fewer bananas, and that we lost $200 worth of bananas in that spoilage. And in order to prove that, we would click Reports and go down to the trial balance, and you can see loss on inventory spoilage would show up for the very first time as $200. The next example would be January 17th. We opened the inventory warehouse and observed that 5 apples have been stolen. Well, you would do the exact same thing. You would click New, go to Inventory Quantity Adjustment, put the date as January 17th, make sure you choose the correct adjustment account, and in this case, loss on inventory theft, so that we know exactly how much money we lost for what we paid for the merchandise that was stolen. And in this case, what was stolen were 5 apples. So we choose apples. Now, we could put the new quantity as 164, or you could just put -5 and push tab, and QuickBooks will calculate 164. It's the same thing. So it is that easy to adjust. Click Save and Close, and now you can see for the very first time, loss on inventory theft shows up for the first time as $50. And if you click Reports and look at your inventory valuation detail, you see on January 17th we lost 5 apples as a result of the theft, and the quantity on hand decreased to 164. Lastly, let's imagine on January 18th, someone gave Holden, the owner, I think the owner is Vonda, I don't know who's the owner, but the crates of bananas, 10 crates of bananas that he can resell were given to him as a birthday gift. Well, that counts as income. It might not be taxable income, but from the point of view of the business, it's donated income, not part of the normal income from operations. So, all you have to do is go to the top left and click New, Inventory Adjust, put the date that you got and put into the warehouse the new bananas, and this time it's the other income account that you will choose, income from inventory that was donated to the company. And in this case, the product was bananas, and the change in quantity is now a positive number. I believe they gave 10. Yes, they did. So the quantity of bananas increases from 170 to 180. That might even be the guy that stole the 10 bananas to turn around and give it back to him. I don't know. Save and close. Now, we look at the bottom of bananas and we see that the quantity on hand increased by 10 for $20 each because that's what we would normally buy it for. So he has income of $200. And you can click Reports and look at the trial balance and see income from inventory donated. Can we make this column bigger? Maybe. And you can click Reports, Profit and Loss, and notice these things are at the very bottom. In other words, here's the net income from normal operations, from buying and selling. Look, here's the difference between your buying and selling, and then here are your other operating expenses. So here's your net income from normal operations, and then you would add income and expenses that you had that were not from normal operations to get your ultimate net income.